Hey guys, Taylor here. Today I wanted to talk about how I'm not waiting 40 or 50 years for my money to compound. I'm going to go ahead and push that snowball some myself and what's been working for me. And I see a lot of people harping on time in the market. Well, some people are older. You may be 40, you may be 50. There may not be many years left. Maybe you didn't, understand investing or hear about investing principles and compound interest until later in life. If that's you, this video is for you. I didn't understand investing or, have an investment background growing up. My parents didn't invest much. So I was in my late 20s when I, discovered the hobby. And since then, I've learned a lot. And there's really three variables. It boils down to a simple math equation. There's definitely time, and I feel like that's what's most talked about. But the other two variables are your rate of return, which you can very much change. You can very much take more risk and try to get a higher rate of return. And then the other thing that I think is sorely misunderstood and just not talked about is the amount of money you invest, the initial principal or your yearly savings rate, how much money you're putting into your stocks and bonds will directly impact your performance. I want to look at some examples and then look into my portfolio and kind of show you guys a glimpse of how I'm kind of supercharging that snowball and how my net worth's grown over the past few years in terms of stocks and bonds. So let's hop into a hypothetical example here. So we will just call this guy Josh. So he's trying to decide how much to save. So I'm going to run you through some scenarios. A lot of people think it takes 40, 50 years to become a millionaire. It does not. You can do it in under 10 if you're diligent. And I'm going to prove that to you right now. So if we were to save $20,000 a year and get an 8% rate of return, which is historically over the past 100 years in line with what the S&P 500 has done after 10 years, we would have $312,000. So one third of a million. Okay. What if we could somehow scrounge up another $5,000 a year, would increase to $391,000. We're getting closer. What if Josh saved $30,000 a year? We see it jumps all the way up to $469,000. And then if we save $35,000 a year over those 10 years and let compound interest do the work, reinvest at our dividends, we would have $547,000. So we are halfway to $1 million after 10 short years. If you're 40, you'd be 50, 50 to age 60. That would be a great bridge until you could get Social Security if you're here in America. But that's only one lever we can pull. So we certainly know that, if you're 40 or 50, you can't produce more time. We only get a certain amount of time on this earth. So, use that time to the best of your abilities. There is one more lever we can pull, especially if you're younger and you do not mind taking on more risk. One of my largest holdings, actually, I believe it is my largest holding. We'll look into that here in a minute. Is the Vanguard Information Technology Fund. And actually, since inception, it has returned about 15% per year on a total return basis, which is almost double the S&P 500. So let's look at the numbers if you had invested in that. So if Josh invests his $20,000 into the Vanguard Information Technology Index, this is definitely a riskier bet, but one that might pay off, especially if we continue to have a technology sector bull market. So after 10 years, investing $20,000 a year, we'd have $466,000. So we're improving. After 10 years, if we'd invested $25,000, we'd be up to $583,000. If we invested $30,000 a year, we see we jump all the way up to $700,000 after the end of the 10-year period. And then the real magic, if we were investing $35,000 a year for 10 years at a 15% annual growth rate, we would have $817,000. So we're actually getting very close. So I think this proves that, increasing how much and how often you're investing definitely can help your snowball build. And then looking into some higher yielding investments can certainly juice our portfolio's returns. Certainly if you're looking into, increasing the risk and the reward, definitely look into the funds that you're investing to. Know their track record. I like VGT because it has a very long track record of outperformance. And do I expect that to continue? I sure hope so. But I'm not going to be disappointed if it doesn't, because I'm just going to be able to buy more and more shares while it's cheap. And then, especially if we have a bear market, I'm in my mid 30s, so I welcome a bear market. That's just a buying opportunity for me. If you're in your 50s or 60s, you might be more looking in line with the S&P 500. You may be looking more in line with some covered call funds that can beef that juice a little bit more. I cover covered call funds a lot on my channel because I think they're a good blend of income and growth if you're in the right fund. So hopping over to Vanguard, I haven't shown my Vanguard account in several months. It was one of my original videos. I might not have even shown my face in that video. So if you saw that video, you're one of the real ones. But looking at my investment returns since I opened this account in October of 2023, I have a total return of $141,000, an annualized rate of return, which is kind of insane at 29.4%. I think that's going to go down a lot. I think it has a lot to prove with just how aggressive my portfolio has been over the past few years. I had an ending balance of last month at $405,000. I'm filming this intraday on July 14th, so these numbers may be wrong even before the video comes out if we have a stock market rally or a big dip today. Stock market's been red the past few days, so hopefully we have a little bounce back today. But looking at my largest holding, I don't talk about it a whole lot on this channel. I usually focus on covered call funds, but I do love the Vanguard Information Technology Index. We can see I have an unrealized gain there of $92,600 and a current balance of $261,000. I also do love SCHD. It's my second largest holding at $54,895. And then the S&P 500 coming in after that, 28,752 into the S&P 500. And then, one of my favorite covered call funds for at least high income, QQQI. I have about $23,000 invested in that, and I just keep reinvesting those distributions. And then I have some single stocks and stuff like that. This is my joint account with my wife on Vanguard. I do own less than $20,000 worth of some highly specific covered call funds like GPIX and TDAX and TDAC in a Robinhood account. Those I buy on Robinhood because some of those leveraged funds, Vanguard's really strict about. They don't even like cryptocurrency or anything. I can't buy any of that in here. And those I look at as kind of more of an experience. I do have QQQI in this portfolio, and I checked the other day, and GPIX is probably the next one I'm going to add into my Vanguard account here, because Vanguard will allow me to buy that from the investigation I've done last week. I put it in order, and it looked like everything was going to go through, so that looked very promising. In my employee-sponsored account, I can't buy VGT in there. It's actually Fidelity. I don't have brokerage link or anything fancy going on in there, so I just have the Fidelity equivalent large cap growth fund in there. Pretty boring, but I'm in my mid 30s, so I'm happy with a lot of risk. And if you can't tell, I've been investing quite a bit. Sometimes over the past few years, to my wife's chagrin. Trying to throw in 40, 50, 60, even 70% of our income before I cut back to part-time. Now I'm not really investing a whole lot other than just maxing out my 401k, because I've officially reached something in the financial independence community, coast fire. So if I just leave all my investments alone, they're going to continue to grow and compound and pay for my retirement. Certainly I do want to max out my 401k. I want to save as much as I can of my salary now that I'm part-time, and grow this fund, continue to grow this fund, continue to reinvest dividends and distributions from covered call funds. I could actually, looking at it, if I swapped everything over, it's like a GPIX mix, and added in some more passive income investing type funds, CLOs, preferred shares, gold, silver funds. If I wanted to get really fancy with it, I could probably, have enough distributions to cover our, minimal lifestyle. We don't need much money at all for, our lifestyle. And, in the next couple of years. If we continue to have some good stock market returns, I expect to be pretty close to the traditional 4% rule. So follow along. I just wanted to do this video to show you guys that, time is an important factor. But if you can save some extra money, if you're a high income earner, if you can just, cut back on some expenses. If you're a low income earner, if you want to pick up some extra shifts and try to bridge that gap, even saving $5,000 extra a year will go a very long way in your investment journey. So I just wanted to put this video out and share some more in-depth stuff with you guys about my investments. And see you in the next